Dear students, welcome to Module 4 lecture video. As before, I will solve a couple of problems from this module. And as I solve those problems, I will clarify some of the concepts. So let us get started. This is the first problem I would like to solve. So we have some income statement and a balance sheet information here. We have to calculate RNOA. RNOA. So this is return on net operating assets. Now this is equal to your NOPAT divided by average net operating assets. Now remember, NOPAT is net operating profit after taxes, and NOA is net operating assets. So RNOA, return on net operating assets, is equal to our NOPAT for 2018 is 2,548 divided by our average net operating assets. So our net operating assets, NOA. So this writing should be net operating assets. For 2018, when we calculate average net operating assets, we have to take the net operating assets of 2018 and 2017. So let me calculate average NOA for 2018, which will be $9,746 plus 10,392 divided by 2. $10,069. And we will get is telling us to round answers to 1 decimal place. So it should be 25.3. If you follow the same process for 2019, you should get 26%. Now, ROA. ROA means return on assets, which is equal to your net income divided by average total assets. So our net income is for 2018, 2,409 divided by average total assets. Let us calculate that separately. So our total assets for 2018, 15,316. And for 2017, 17,283 divided by 2 should give us average total assets. Now we can divide net income by this average total assets. It's asking for 1 decimal place, it will be 14.8. So if you follow the same process, you should get 15.4% for 2019. Now return on equity, or ROE. This is equal to net income by average equity. So our net income for 2018, 2,409 divided by average equity. So average equity is equal to our 2018 equity and 2017 equity. So we have the same numbers, so the average will be the same actually. We don't need to do the average calculation. So which will be with 1 decimal place, it will be 71.9%. Following the same process, you should get 73.3%. adjust equity and total assets for the amount of treasury stock. So treasury stock. So treasury stock reflect the value of the shares that have been bought back or repurchased from the shareholders. So that reduces your equity. So this question is telling us we need to adjust the equity and assets by the amount of treasury stock. So we need to add treasury stock to both the equity and the total assets. So our assets restated will be for 2017, $17,283 plus our treasury stock of 14,628. $31,911. If you follow the same process, you should get 31,808 for 2018, 33,363 for 2019. Now for equity restated. Our equity is 3,352 for 2017. Add treasury stock. $17,980 for 2017. Following the same process, we'll get 19,844 for 2018 and 20,960 for 2019. Next question is, using these restated numbers, recompute RNOA, ROA, and ROE. 1 decimal place. Okay. So we'll follow the same process as before for RNOA. So RNOA is NOPAT over average net operating assets. So in this case, our adjustment did not affect NOPAT or net operating assets. So the value of RNOA will not change. So we'll just copy and paste the numbers from the previous part. Now, return on assets for 2018. So return on assets is net income over average total assets. Our net income for 2018, 2,409, divided by average total assets. Our assets changed, so we need to recalculate the average total assets. With one decimal place, that should be 7.6% for 2018. Following the same process, you should get 7.3% for 2019. Now, return on equity. Our net income for 2018, 2,409. We need to recalculate average equity. So our equity changed. So within one decimal place, it will be 12.7% for 2018. Following the same process, you should get 11.6% for 2019. Part C, which profitability measures from Part A or Part B better reflect the company's profit levels during the 2 years? Part A, using reported numbers. Part B, using restated numbers. So we have adjusted our equity with treasury stock. The reason is sometimes treasury stock is significant in it actually decreases the shareholders' equity significantly. So after adjusting with treasury stock, meaning after adding back the treasury stock to the equity, we can get a better representation of shareholders' equity. So that is why our answers will be Part B using restated numbers. I will make this bold to indicate this is the correct answer. Of the three measures, which one is least influenced by the company's stock repurchase activity? Now, our return on assets changed. Our return on equity also changed after we have adjusted with treasury stock, adjusted both total assets and equity with treasury stock. However, our return on net operating assets did not change because we do not have total assets or equity in these calculations directly. So return on net operating assets is the one that is least affected. Next question. So we have a statement of earnings, statement of income, balance sheet, cash flows. First, we have to calculate current ratio and quick ratio. So current ratio is current assets divided by current liabilities. Okay. So for 2016, and current assets and current liabilities, these are balance sheet items. So we need to go to the balance sheet. So for 2015, it will be our total current assets is 14,573 divided by our total current liabilities, 13,918. Two decimal place. Should be 1.05. So this number was for 2015. So it should be here. If you follow the same process for 2016, you should get 1.20. Now, quick ratio. Quick ratio, in calculating quick ratio, we take cash, add marketable securities, and accounts receivable. That is for our numerator. And then divide by current liabilities. Now, notice we are still including some of the items that constitute total current assets, but not all. We do not include inventory because inventory is not as liquid as cash, marketable securities, accounts receivable. We also do not include prepaid assets. So for 2015, our quick ratio will be, we need to go to balance sheet. So our cash and cash equivalents is 1,090. Receivables, 7,254. Okay. Divide by total current liabilities. So 2 decimal place. So it should be 0.6. Following the same process, you should get 0.8. Which of the following best describes the company's current ratio and quick ratio for 2016 and 2015? The current ratio has increased, so that is true, while the quick ratio has decreased. Quick ratio also increased, in fact, so that is not true. Both the current and quick ratios have decreased. That is not true. Both the current and quick ratios have increased. Yes. The current ratio has decreased. That is not true. Now, part B. We have to calculate total liabilities to stockholders' equity. So that is equal to your total liabilities divided by your equity. So for 2015, this will be, so liabilities and equity, these are also balance sheet items, will go to balance sheet. So total liabilities 46,207 divided by total stockholders' equity 3,097. Two decimal plus, so it should be 14.92. Following the same process for 2016 should give you 28.77. Now total debt to equity. So to calculate total debt to equity, in the numerator, we will take long-term debt including current portion of long-term debt plus short-term debt. And then we'll divide by stockholders' equity. So in this case, we are looking into debt, not total liabilities. When we talk about total liabilities, it also includes accounts payable, etc. So for 2015, our long-term debt, these are also balance sheet items. So we'll go to balance sheet. Our long-term debt, 14,305, including current portion of long-term debt. So let us see if we have anything like that. So here, current maturities of long-term debt. We have 956. We do not have anything for the next year, 2016. And then plus short-term debt. So we don't have any short-term debt. Divided by stockholders' equity. Just copy paste from the previous one. Do 2 decimal plus 4.93. following the same process for 2016 should give you 8.89. Next question is, which of the following best describes the company's total liabilities to equities ratio and total debt to equity ratio for 2016 and 2015? The total liabilities to equity ratio has decreased. Total liabilities to equity ratio has actually increased, so that is not true. Total liabilities to equity ratio has increased, correct, while the total debt to equity ratio has decreased. Debt to equity ratio has also decreased, so that is not correct. Both total liabilities and total debt to equity ratios have increased. That is correct. Both total liabilities to equity and total debt to equity ratios have decreased. That is not correct. Part C. We have to calculate times interest earned. So times interest earned is equal to earnings before interest and tax. It is also called EBIT, also called operating profit, divided by interest expense cross. So for 2015, earnings before interest and tax, these are income statement. So we'll go to income statement to find these items. Earnings before interest and tax, or EBIT, are also called operating profit. This is our operating profit, divided by interest expense. So this is our interest expense, 443. I'll ignore the negative sign. Two decimal place, so it should be 10.64 for 2015. Following the same process, you should get 8.37 for 2016. Cash from operations to total debt. This is our cash from operations to total debt. So this is equal to your cash from operations divided by short-term debt plus long-term debt. So for 2015, cash from operations. So these are cash flow statement. We are talking about cash. Cash from operations is a cash flow statement item. So we have net cash provided by operating activities, 5,101. Now divided by short-term debt, we need to go to balance sheet. We don't have So we don't have short-term debt, but we have current maturities of long-term debt. So we need to include that plus our long-term debt. So that should be equal to I'll redo the calculation. I'll calculate the denominator first. It is asking for 2 decimal. So it should be 33.43 in terms of percent, but it is not in percent. So it should be 0.3343. Point 3343. Following the same process, .33, just 2 decimal place. Following the same process for 2016, you should get 0.36. These are not in percent. The next ratio is free operating cash flow to total debt. So this will be equal to our cash from operations, like before, but we'll subtract capital expenditure. In short, CapEx. So what that basically means, we are focusing on the cash that is left after we have invested in capital assets like machines, equipment, long-term assets. And our denominator will not change. Short-term debt plus long-term debt. So for 2015, our cash from operations was 5,101. I'm going to cash flow statement again. 5,101. Now we have to subtract CapEx. So capital expenditure, it is an investment. So it should be under investment. So 939. We'll ignore the negative sign. This negative sign here means the cash was invested. Divided by short-term debt plus long-term debt, which you already calculated here. We'll copy paste from there. So it will be we calculated that so only 2 decimal place. Following the same process for 2016, you should get 0.29. Now it is asking us which of the following describes the company's times interest earned: cash from operations to total debt, and free operating cash flow to total debt. Select all that apply. Lockheed Martin's free operating cash flow to total debt ratio slightly decreased. Free operating cash flow to total debt slightly decreased. That is not true, it actually increased. Lockheed Martin's times interest earned decreased during 2016. Times interest earned. That is true. Yes. Lockheed Martin's cash from operations to total debt ratio slightly increased. Cash from operations to total debt slightly increased. True, over the year 2016 due to a decrease in total debt. So due to a decrease in total debt. So we have total debt for 2015, 15,261. Let's see, 15,261 for 2015. For 2016, it is 14,282, and we don't have any current maturities of long-term debt. So that is also true, that in 2016, total debt decreased. 14,282 in 2016 versus 15,261 that we calculated previously for 2015. So that is also true. I'll write down here. Finally, Lockheed Martin's times interest earned increased during 2016. It actually decreased. So that is not true. I'll cut paste this yes in here. Okay. Now summarize your findings in a conclusion about the company's credit risk. Do you have any concerns about the company's ability to meet its debt obligations? Lockheed Martin's total debt to equity ratio is low. Let's see, total debt to equity ratio. Total debt to equity ratio. So 4.93, 8.89. So that is not true. Debt is almost 5 times of equity. And it got worse in 2016. It is almost 9 times of equity. So that is not correct. Lockheed Martin's quick ratio is low, thus increasing immediate solvency concern. The company's ability to meet its debt requirements will depend on liquidating inventories for emergency cash. Quick ratio is low. Let's see. Now, quick ratio, we don't have an exact benchmark to compare. It is true it is below 1, but it doesn't mean it has immediate cash concern, because if you look into current ratio, it is above 1. So this is not a concern for Lockheed Martin either. Lockheed Martin's times interest earned ratio is strong, thus lessening any immediate solvency concerns. So in 2015, it was more than 10 times. Remember, times interest earned ratio is your EBIT, your operating profit, operating income, divided by interest expense. So EBIT is almost 11 times or more than 10 times. And in 2016, it is more than 8 times. So these are much better numbers, very strong numbers. So interest ratios are strong, lessening any immediate solvency concerns. So that is true. The company's ability to meet its debt requirements will depend on its continued profitability. So that is true. Lockheed Martin's total liabilities to equity is high. Liabilities to equity. Yes. So if this ratio is above 1, so that means this company has more liabilities to equity. In 2015, this company has almost 15 times liability compared to equity. It got worse in 2016. It is almost 29 times. Total liabilities are 29 times of equity. So liabilities to equity is high, thus lessening any immediate solvency concerns. This part is not true. So liabilities to equity ratios are high, so that means they have solvency concerns. So that is not true. Moving on to the next problem. Question 3. So we have to compute and compare Altman J-score for both years. So what is Altman J-score? I have to show this from the book. So this is how to calculate Altman J-score. So it is used in predicting bankruptcy of a company. For example, if you look into these scale and interpretation, you'll be able to predict. If the J-score, that means the value that you get using this formula, is greater than 3, the company is healthy and there is low bankruptcy. If the J-score is greater than 1.8 but less than 2.99, there is a gray area. Companies exposed to some risk of bankruptcy, caution is advised. If the J-score is less than 1.8, then company is in financial distress and there is high bankruptcy. So I'm going to copy this and paste here. And also the table with interpretation. Okay. So first we have to calculate working capital. So working capital is current assets minus current liabilities. So our current assets I'll focus on 2018 for now. Our current assets, 17,134. And our current liabilities, 6,040. So I'll calculate this, 17,134. And we have to divide by total assets. So working capital, in short WC, divided by total assets. Our total assets for 2018 24,536. I'll use only 2 decimal place. Let me use 4 decimal place, so it will be 2, 2. We'll get a more precise answer. So that is our first ratio, working capital over total assets. And then we take this, multiply by 1.2. So that will be equal to 1. The next one is retained earnings over total assets. So our retained earnings in 2018, 3,517 divided by our total assets, .1433, and then we'll multiply by 1.4. Okay. So this is one, and then this is another. Now, EBIT over total assets. Our EBIT is operating income so it doesn't give us EBIT directly, so we have to calculate it, which will be our gross profit, 17,956 minus the sum of demand creation expense and operating overhead expense, which is 11,511. So that is our EBIT. There should not be an A here. Divided by total assets. So our calculation will be 17,956 minus 11,511 divided by our total assets was 24,536. So 0.2627 4 decimal place. Now we take this number and multiply by 3.3. So 3.3 times assets. So which will be 3.3 times this number, 0.2627. Okay. So that is our third calculation. Now, fourth one is market value of equity. So market value of equity divided by total assets. So market value of equity is equal to your number of shares times price per share. So your number of shares times price per share divided by total assets. So our shares outstanding is 1,272. Price 71.80. Divided by our total assets. It was actually total liabilities, not total assets. So total liabilities. So our total liabilities are it doesn't give us total liabilities, but we can calculate. We can take the total current liabilities, 6,040, plus our long-term debt, plus our deferred income taxes. Okay. So this will be $12,724. So now I'll do the division. Four decimal places. Now we'll multiply this number with 0.6. Okay. Now our next component is sales over total assets. This one is easy. Our sales was 38,397. Our total assets, 24,536. So we take this number and multiply by 0.99. 0.99 times 0.99. Now all we have to do is to add these final numbers from each ratio. So our z-score will be this plus this plus this plus this this. So this is our z-score, 7.466041. So I'll copy this right down here. If you follow the same process, you will get 6.47669. Okay. Which of the following explain, before I move on, so if you compare this number or this number even, so 2018 and 2019 z-score, you can see that the company is in a healthy financial situation. There is low bankruptcy potential in the short term. Okay. Now let us move on to the next question. Which of the following explain the trend in the z-score from 2018 to 2019? Nike improved its working capital by decreasing its current liabilities. Nike improved its working capital. Let's see. So working capital was 11,094 in 2018. And in 2019, working capital total current assets minus total current liabilities. So previously it was, in 2018, it was 11,000. It is now 10,000. So this is not true. It did not improve. It decreased. So no. Nike decreased its liquidity due to an increase in retained earnings. Let's see. What happened to retained earnings? Retained earnings decreased. So 2018 to 2019, retained earnings decreased. Nike decreased its liquidity due to an increase in retained earnings. So retained earnings actually decreased, not increased. So that is not also true. Nike improved its earnings before interest and taxes by increasing its total net sales. So net sales, it did increase. So net sales increased. Nike improved its earnings before interest and taxes. Okay. So okay. The market value of Nike's equity improved over the years. So in 2018, market value of equity was 91,000. Now, 2019 market value of equity is, so a number of shares outstanding, 1253, multiplied by stock price 77.14, which is 96. So previously it was 91, now it is 96. So market value of Nike's equity improved, so that is also true. So that is the end of this question, this problem. That is it for today's lecture video. I will see you in the next lecture video. Have a good week. Bye.